Welcome back to our channel, where we dissect the most intriguing financial trends, theories, and forecasts. Today, we're shining a spotlight on Howard Marks, co-founder of Oaktree Capital Management, who has recently been discussing a sea change in the investment landscape. If you're ready to uncover the investment wisdom of one of the world's most successful investors, then let's dive in. Who is Howard Marks? Howard Marks is an iconic figure in the financial world, with a reputation that precedes him. As the co-founder of Oaktree Capital Management, one of the largest distressed securities investors in the world, he has navigated the highs and lows of the market for decades. Mark's acumen, along with that of his team, has guided Oaktree to its esteemed position in the industry, managing around $120 billion as of my knowledge cutoff in September 2021. His reputation isn't just based on his leadership at Oaktree, though. Marks has become something of a sage in the investing world, offering his wisdom through his insightful memos. These pieces of communication have been widely shared and read within and beyond the investment community, offering unique perspectives on current events and market trends. His ability to dissect complex economic issues and present them in an understandable and relatable way is one of his standout qualities. Moreover, Marks is also the author of the book The Most Important Thing: Uncommon Sense for the Thoughtful Investor, which has become a must-read for anyone serious about understanding the world of investing. The book distills his investment philosophy, underscoring his emphasis on risk management, price sensitivity, and the importance of being contrarian when appropriate. Howard Marks is a figure who has not only achieved significant success in the financial world, but has also used his platform to educate others on the principles of thoughtful investing. Investing topics: interest rates, inflation, the Federal Reserve. Marx's discourse on the sea of change in the market is deeply intertwined with the concepts of interest rates, inflation, and the role of the Federal Reserve. These factors are fundamental drivers of the global economy and can significantly impact investing outcomes. Let's delve deeper into each of these topics. Interest rates. Marks has often highlighted the profound influence of interest rates on the market performance. For instance, he cautions against expecting high returns from bonds due to declining interest rates. This is because when interest rates fall, the fixed interest payments of bonds become more attractive, pushing up their prices and consequently lowering their yields. On a broader scale, lower interest rates have been a key driver of asset price inflation over the past few decades. They make borrowing cheaper, encouraging businesses and individuals to take on more debt to finance spending and investment. This influx of cheap money can drive up the prices of assets like stocks and real estate. But the flip side is that when interest rates start to rise, as they might do in the face of inflation, the cost of borrowing increases. This could put downward pressure on asset prices and can be a significant headwind for investors. Inflation. Inflation, or the general rise in price levels, is another critical factor for investors to consider. When inflation is high, the purchasing power of money decreases, impacting consumers and businesses alike. This can be particularly harmful for investors if the returns on their investments don't keep up with the pace of inflation. On the other hand, some assets like real estate or certain stocks can potentially serve as inflation hedges because their value might rise with inflation. Marks refers to the late 1970s, a period of soaring inflation, when the then Fed chairman, Paul Volcker, took decisive action to control inflation by significantly raising interest rates. This era, commonly known as the period of stagflation, was a challenging time for investors, especially those not prepared for such high inflation levels. The Federal Reserve. The Federal Reserve, often simply referred to as the Fed, plays a crucial role in shaping market conditions. As the central bank of the United States, the Fed controls monetary policy, which includes managing interest rates and controlling the money supply in the economy. Through these levers, the Fed can influence economic growth, inflation, and the overall financial stability of the country. Marks emphasizes the impact of the Federal Reserve's policies on the investing landscape. For instance, the era of low interest rates that we've seen over the past few decades has largely been the result of the Fed's policies. These low rates have made borrowing cheap, fueled an era of easy money, and led to significant price appreciation in many asset classes. However, the Fed's actions during the Volcker era show that the central bank is willing to take drastic measures when necessary, including hiking interest rates significantly to combat inflation. This serves as a reminder for investors that market conditions can and do change, often driven by macroeconomic policies. The impacts of rising interest rates. Indeed, the investing landscape is changing at a rapid pace. One notable shift is the recent increase in interest rates, which is occurring at one of the fastest rates in history. Howard Marks highlights the significance of this trend and what it means for investors, the economy, and future asset returns. For investors, a rising interest rate environment presents both challenges and opportunities. For bond investors, rising rates mean newly issued bonds offer higher yields, but the prices of existing bonds in the market fall as they become less attractive compared to the new higher-yielding bonds. On the other hand, savers can earn more on their deposits. For stock investors, the impact can be more complex. Higher interest rates mean higher borrowing costs for companies, which can lead to reduced profits and slower growth. This can potentially dampen stock prices. However, companies with strong balance sheets and cash flows may be better positioned to weather these conditions. Economically, rising interest rates can slow down growth as borrowing becomes more expensive, potentially leading to reduced spending by consumers and businesses. This can have a ripple effect across various sectors of the economy, potentially leading to slower overall economic growth. In terms of future asset returns, the impact of rising interest rates can vary. As mentioned, bond prices tend to fall when interest rates rise, potentially leading to capital losses for bond investors. However, for new investments, higher interest rates mean higher yields. For stocks, the impact can depend on a variety of factors, including how well companies can manage higher borrowing costs and whether they can pass on these costs to consumers. In this changing landscape, Marks advises investors to adapt their strategies to a rising interest rate environment. This might mean shifting towards assets that can perform well during such times, or simply being prepared for potentially lower returns on some assets. As always, Marks emphasizes the importance of understanding risk and maintaining a balanced, diversified portfolio. If you find this video interesting and informative, hit the like button. We appreciate your support, and this motivates us to provide more valuable content to help you in your financial journey. Expectations for future stock market returns. When it comes to expectations for future stock market returns, Marks provides a cautionary perspective. He argues that the investment environment of the future may look different from what we have seen over the last 40 years. The low interest rate environment, which has underpinned much of the growth in asset prices, may not continue indefinitely. Marks suggests that the era of cheap and easy money, fueled by low interest rates, may be nearing its end. If interest rates were to rise significantly, the cost of borrowing would increase. This could lead to a slowdown in economic activity and potentially lower asset prices. For equity investors, this could mean lower future returns compared to the impressive gains seen in recent decades. Furthermore, if inflation were to rise significantly and persistently, this could also impact stock market returns. High inflation can eat into the real returns of investments, making it harder for investors to grow their wealth. It can also lead to higher interest rates as central banks like the Fed may raise rates to combat inflation. Thus, Marks's outlook is a reminder for investors to be prepared for different market conditions and to adjust their expectations accordingly. It underscores the importance of considering macroeconomic factors like interest rates and inflation in investment decisions, and not to rely solely on past performance as a guide for future returns. Remember, the investing world is complex, dynamic, and influenced by various factors, including macroeconomic policies and global economic trends. Staying informed and understanding these dynamics is crucial for making sound investment decisions. Conclusion: Howard Marks's insights into the sea of change in the investment world are a reminder that the only constant in investing is change. As we navigate the financial markets of the future, it's crucial to understand the factors that shape these markets, including interest rates, inflation, and the actions of the Federal Reserve. Investing isn't simply about picking stocks or following trends, it's about understanding the broader economic environment and how it can impact investment outcomes. Marks's wisdom serves as a reminder of the importance of this holistic approach to investing. As we move forward, it's essential to stay informed about these shifts and understand how they could impact our investment strategies. If Marx's predictions hold, we may see a shift in the investing landscape that could pose challenges for those unprepared. However, it could also present opportunities for those who understand these dynamics and know how to navigate them. We hope this deep dive into Howard Marks's recent insights and the broader economic themes of interest rates, inflation, and the role of the Federal Reserve has provided you with valuable perspectives to consider in your investment journey. The investing world is ever evolving, and staying informed is one of the best ways to prepare for the future. If you found this content valuable, please show your support by giving this video a thumbs up. And don't forget to subscribe to our channel for more insightful financial content. Let's continue to learn together, navigate these changing investment waters, and strive to make informed, thoughtful investment decisions. We'll see you in the next video.